And let me bring on board Devina Mehra. Of course, needs no introduction, but founder CMD First Global, joining us this morning. Devina, firstly, wishing you a very, very happy Women's Day in advance, of course, but wishing you that. Give us a sense. What are you seeing in terms of how the market is moving, and what is it that you're doing in this market at this point? Where are the opportunities, if at all there are any?
Thank you for the good wishes and wishing all your women viewers and the women in the team very happy Women's Day. So as far as what is happening is concerned, it is, it's a situation where you have to step back and look at things a bit. So it is not just that what's going to happen tomorrow. We have to look at what happens when such kind of geopolitical conflicts happen. And this was actually a data study we did in 2022 when there was tension building up on the Russia-Ukraine front. And we went back 50 plus years. We looked at all the geopolitical upheavals for the two Gulf Wars, Afghanistan, 9/11, US bombing Libya. And what we found was very, very stark. So if your narrow lens is the markets, you forget about the humanitarian costs and all that, that the stock markets recover within 6 months to a year. And it was not a statistical exercise. We did not find an exception to that rule. So every single time, the markets of the countries that were directly not in the conflict recovered. The second part, of course, is the conflicts never get resolved that quickly. I mean, Iran is a huge country. It's more than half the size of India and has an army and an arsenal. But even when adversaries are as mismatched as US and Afghanistan or US and Vietnam, the wars don't get over. Remember Russia, Ukraine, we are 4+ years into it. But as I said, if the narrow lenses markets, the markets recover. And 6 months after the Russia-Ukraine war broke out, I remember newspaper headlines in Indian newspaper saying 6 months, but the markets have forgotten about it. And I said it on the day. And also I did a 50+ year analysis. Yesterday I saw in Financial Times, they have a 100+ year analysis, including the world wars and all that. And their conclusion was that don't react to geopolitics. It always, kind of plays out. Actually, the bigger shocks to the markets have been the non-geopolitical events like the 2008 crisis or 1929. So those actually took down markets much more than geopolitics. The geopolitics, the markets forget within a reasonable time frame. So my advice on the weekend had been that if this week gives you an opportunity, you had some cash lying around, it would be the time to deploy it from a longer term point of view. Nobody knows what markets actually do in 6 months or even 2 years. So that's why I always say equity money is money you should not require for the next 8 to 10 years. But if you look at for example, the third quarter earnings, I think I must have said it on your channel also before that quarter ended that I expected the Q3 earnings to pick up, and that has happened. And the aggregates don't even capture it fully because for manufacturing companies, they more or less captured it. But for services companies, there was this quarter a reasonably large hit on account of the new labor code. So if you add that back, the earnings have been accelerating. Yes, I mean, oil will be a shock for India as an economy and the Indian, a number of the Indian companies. But, let's see how much of an impact that makes. Remember, almost 2 decades ago, we lived with the $100 plus oil.
Yeah, absolutely. Devina, hi, morning. Are you joining us from Dubai? I just wanted to check in on you. Hope all's safe because,
No, I'm in Mumbai just now.
Okay, great. Relieved to hear that. But Devina, since you just did mention oil, and that is the problem, or rather the differentiating factor than a Russia-Ukraine or the many other recent wars. How do you think that piece is going to get navigated? Will the markets, because they're looking a little bit fragile in any case right now, India is the big anti-AI trade, if I can call it that. Do you think the move could be a little bit more exaggerated?
But if you go back to the Russia-Ukraine time, both Russia and Ukraine are very large commodity players. I mean, oil and gas, as well as things like wheat and a whole lot of metals. So, I mean, of course, you have to work through the numbers for particular companies with scenarios. If oil goes up, what happens? And I think Iran is playing it very tactically, and from their point of view, I would say very smartly, that they are increasing the cost of the GCC countries being in this conflict. That, and you will see from the statements, let's say, of the UAE Foreign Ministry. I mean, they're more or less saying, why are we fighting somebody else's war? Why are we the theater of war for something that doesn't concern us? And they must all be wondering why they are fighting Israel's war, and that too in the holy month of Ramadan. So this is, they are paying the cost, and it is not even their war. And the Iran's tactic has been to increase the risk premium, whether it is the Straits of Hormuz or whether it is GCC real estate. Everywhere you are removing the safety net. Do you find insurers even to insure any of this? President Trump made a statement that, we will insure it, and asking an institution which has never done any insurance in its life to do this. So they are basically hitting it where it hurts in terms of the economies and the risk premium. And I hope sense prevails, because this was completely, I don't know what this conflict was or is supposed to achieve as the end game. So it's kind of, I'm still not clear.
Yeah, and it seems like
But as I said, if the narrow lessons markets, I don't think this is the time to get out of whatever is your equity allocation. Your equity allocation should never be 100% of your portfolio, but whatever is your allocation, I don't think this is the time to get out.
Right. But, Devina,
I can also just tell you a little bit,
Sure.
since we talked about oil. So even before this conflict started, about a little over a month ago, when we had done our global rebalance, we thought oil was due for an up move, much before this happened. So actually, in that last rebalance, the only significant thing we did was to reduce US equities further. We were already underweight. We went further underweight, and we put that money into commodities, so both oil and metals.
Devina, hi. With all these uncertainties around India, how do you look at Indian companies and the earnings? Because the entire market has been flat or in a range bound, looking for a reason to move up. And the reasons was basically the earnings upgrade or earnings growth coming in for many of the companies.
Yeah, so I mean, as I said, Q3 earnings have shown an acceleration, which is what I was expecting. Earlier, I was expecting Q2, but as soon as the GST changes came, I knew, Q2, there's basically a kind of turmoil because of the GST, even though it's eventually good. So that kind of slipped into Q3. And so that, I think earnings, as I said, you'll have to look at certain specific companies. So, I mean, see, index level earnings are never very useful to look at, because they get skewed by one or two numbers. And what you have to look at is company by company, sector by sector. And even the P's, if at all you want to compare over a period of time, you should look at industry wise, because the composition of the index has changed so much. 25 years ago, there weren't any banks in the index. Now that's the highest weightage. But to just give only one example, and we had actually done that exercise of industry-wise Ps, and we didn't find that the Ps were at the extremes anyway, even before these Q3 earnings. So, I mean, those have become a little more reasonable. So, as I said, you have to step back. I'm not telling you what will happen in the next 1 week or 2 weeks. That's not the call you should be taking. But, I mean, past history, as I said, I have not found a single exception where the markets, other than those directly in the conflict, have not stepped back. So, and as I said, I don't know whether this conflict will last that long, because obviously the US allies in the region are feeling the pain, and they will pressurize the US to stop this. And I think that was Iran's game all along. So as somebody says that chess, Prussians have been playing chess for thousands of years, literally, and they know the moves. So they are thinking a few steps ahead.
Well, let's see who wins then. But Devina, just coming back to that earlier point that you said that this is a good buying opportunity right now. The other question investors are also grappling is that do they now strategically relook at their portfolio construct? Do you have to have more exposure to defense? Do you up your exposure to gold and silver? What do you do with metals? And do you now restructure, get off a little bit exports, have your portfolio more domestic focus?
So in the short term, yes, exports would be hurt. But as I said, I don't think that's like a forever situation. It is obviously, I mean, that's maybe this quarter, the export-oriented companies will show not the kind of earnings that were expected. So, this is, of course, there. In terms of where we are, we continue to be positive on pharma, healthcare. We had a little bit of cash, which we have deployed yesterday. Not a whole lot, but I think we had something like 5% or something, so which we deployed. So that you have to look at obviously sector by sector. And as I said, pharma healthcare is something we are positive on. Auto components we have been, and to a degree, autos also we've been positive on. So that still continues. Those are the places where we are overweight. We have some capital goods, some chemicals and all that. So that we are continuing with. Metals, I don't think is a big negative. Anything which is happening is a big negative for metals because anyway, mostly Indian metal companies don't export a lot. I mean, for the most part. So that's overall. I mean, we are not changing our strategy very, very drastically. We are just adding a few companies that are looking better on our systems.
Devina, the last piece is with regard to PSU versus private, right? On the banking side of things. And of course, you have a long history of making good calls in the space. You've obviously now switched over to the PSU side. Just probably trying to understand the rationale and play devil's advocate, because we were speaking to Sridhar Sivaram yesterday, and he was suggesting that the market share gains on the PSU banking side is likely to continue, largely because the PSU banks are willing to do business at a far lower margin versus private banks, and therefore that market share switch will continue to happen. I'm trying to understand from you whether you have a view with regard to whether there is any mispricing happening at a PSU banking level, at least at this point. And if so, would that pain come across in the next cycle? And if so, when does that play out?
So first of all, let me repeat something which I say in every single interview when asked about banking and lending, that I am a nervous investor in banks and lenders. That's the structure of the industry, is that it's a highly leveraged industry. It's an industry by structure will always have more negative surprises than positive surprises. In the last, few months itself, we have seen that play out in 2 private sector banks. And you don't know where those negative surprises are hiding, either last one was outright fraud, but otherwise there are problems in the credit book or the trade book. Remember, a single 30-year-old trader brought down Barings Bank, which was a 200-year plus old bank. So that kind of risk doesn't exist in any other industry. So I am normally very, very underweight banks, but I mean, it is the largest weight in the index, as I said, so you can't completely ignore it. So we had actually been increasing PSU banks from the beginning of 2025. So it's well over a year since we increased that weightage. And through 25, we increased first PSU banks, and towards the end, I think we added a couple of private sector banks also. So for now, I'm not overweight banks, but I'm holding a lot more than what I used to. But as I said, I'm always skittish and nervous about banks. So, I mean, we will reevaluate again and see whether any changes need to be made. And as I said, if it wasn't such a high weightage, I would have been glad not really to invest in that sector. Because as an outsider, you don't know where the problems are hiding, and there's no way you can know. That's the whole point. Even though, one of our most famous calls has been a positive call on HDFC Bank exactly 30 years ago, 1996. But that aside, that when it had just it was a year out of its IPO, and we said the baby will become Arnold Schwarzenegger. But that aside, as I said, structurally, it's a risky place. I mean, it makes me nervous.
Okay, Devina, thank you so much for joining us this morning, giving us that perspective. And of course, wishing you a very, very happy Women's Day once again.